My name's Craig Birchall. This afternoon, basically what we hope to achieve is to give you some insights, give you some thinking, give you some knowledge, maybe give you some preparation in looking at your future funding. Okay, so obviously hardware and software's become a big thing nowadays. The costs are going up in certain areas and coming down in other areas. What we hope to arm you with on behalf of Investec is the information to make the right decision on how you purchase moving forward. Before I even kick off, we do have a very informal structure. So we're running a panel. Questions are welcome at any stage. In fact, I've got a ton of rugby balls here that I'd love to throw around the room, hopefully not hit the cameraman, but I'd love to throw around the room. I'm yet to have a question that stumped my gurus.
How do we get into your box?
How do we...
Your corporate box.
And which event?
This is a family show. Right. I'm not sure I'll put that one on the whiteboard. I would love to get a question that would stump these two because they've managed every ball, but fair enough. He's managed to answer all questions pretty well thus far. Before I get into our structure and do formal introductions, if there's one thing that you wanted to achieve from this session, being a finance session, if there's one thing you wanted to achieve, if there's one question you've always wanted to ask a finance partner and never had the opportunity, please let me know now. And we'll make sure we'll cover it off in these 20 minutes.
Personal guarantees.
Personal guarantees, what's the question?
Why?
Why personal guarantees? Cool. We'll put that up there.
I'm sure it won't stump you.
Might have heard that question before, so should hopefully be able to cover it off and explain why and why not.
Any others? Right, let's head right into it then.
Don't I get a footy?
Okay, he does.
I bet Benny's not enough.
Righty, so just to touch on again, my name's Craig Birchall. I've had around about 15 years asset finance experience through a number of different entities. I've got a memory like a sieve, so I don't remember a thing, so I'm basically going to throw a whole lot of questions at these two. On the far side, we've got Peter MacMillan. Peter MacMillan's got 27 years experience in the asset finance industry, just shy of 22 years running his own business. So he has an experience of thinking as a business owner, but the business he ran was a vendor finance company, so he also thinks as a lender. Has worked with the print industry for the majority of that time. Bernie's just Bernie, we have him here for entertainment value. Having said that, he does have 20 years experience in lending as well. Bernie's got a bit of a subset of experience. He's worked with one of the traditional big four banks, as well as an asset finance specialist. And we'll go into the differences between those two a little bit later in the presentation, so Bernie can speak on behalf of both and the differences between the two. So to kick things off, we'll come back to our why personal guarantees question. So Peter, in your 27 years of asset finance, you've seen a lot of change. You started with an abacus financing typewriters and had a whole lot of hair. To now the transaction has changed somewhat. Just want to elaborate on that first.
It's 27 years and it's 27 years that have flown by, but just to give me a bit of carbon dating, I'll talk about some of the assets that I financed in those early days. So I don't know if any of you remember those old suitcase style mobile phones with the batteries about this big with the handle that you take, and if you want to impress people you lifted it up and put it on the bar, or the one in your car where it took up 2/3 of the middle of your car and things like that. So when I first came into the game in the mid 80s, that's what we were funding quite a lot of. They were the latest, hottest technology. Anyone who was successful in business had one of those in their car, and now any teenager has one of these with about 1,000 times the power of those sort of things. So from that to carrying around the old thermal faxes, and I'm guessing a few of you remember the days of the old thermal fax, and there was the old big ones that used to feel like they weighed about the weight of a Heidelberg press. They were so hard. At the end of a rental, you go and pick them up and put them in your car to take back to the office and things like that. So back in those days, the asset was the core part of what we financed. So if you go back into the 80s and 90s, the asset was the core part of what we as a financier would be looking at. There was a real value in that asset that the financiers saw. So when they were lending, they looked at the asset and its resale value. In a worst case scenario, if the client unfortunately fell over, they would look to the value of the asset as their first port of call to sell and recover their money, and then look at the client, their capacity to pay and things like that. You fast forward 27 years, and the hardware's become such a smaller part of the total solution because you have the hardware and the great technology that it is today, but then on top of that you've got a significant portion that will be software, and the software that drives all of that. You've got professional services, consulting services, and a number of other intangibles, maintenance and things that are locked into the whole solution. So today we're finding that the hardware is ending up being less than half of the transaction that we're looking at funding. So that's changed the dynamics of how we actually look at a deal, the risks associated with the deal, and whether we ask for personal guarantees and those sort of things do make up part of that mix. But the reality is today, the asset has become less of a component of the asset we're financing, so a lot more weight's put onto the client and their capacity to service it, and the asset is secondary, because in all honesty, if we do have a repossession situation with most assets, we're going to write off most of our money. So that's the big change for us. So now that's the negative side of it. The positive side of it is how do we glue it all together so that the customer can get the total solution they want, including all of those intangible pieces, the software, the professional services, the maintenance, and fund it over the longer term so they don't have a impact to their cash flow right on the day of the solution. They can spread that out over the useful life of the solution. So that's, as I said, the big change in the industry.
And just recently we've seen evidence of it being exaggerated with the right knowledge and the right client.
Well, it's the point now where our credit team are getting more and more comfortable with the intangible unsecured nature. We did a multi-million-dollar software-only deal the other day, so it can be done. Obviously, the credit has to be quite solid for that, because if that falls over, you just write the whole lot off. So, but we are now looking at 100% software financing proposals.
So what sort of risk margin does that attract?
Depends on the client. Obviously, you go from government grade where it's low to no risk down to an SME where the risk profile is exaggerated quite a lot. So depending on the size of the business, you can have a fair loading on the risk. But at some point, you can't put enough risk margin into it, so you just go, it's a deal that either stands up or not. There's not a gulf between your AAA and your small business, the rates are charged, but enough to be able to put enough aside if one was to fail.
It's fair to say those 100% software transactions are very much dependent on the credit and they come down to individual circumstances, so they are looked at very closely, and it's not a vanilla rate share.
Yeah, but as you're saying, the greater majority of deals these days, I would imagine, the government order 6,000, for example, and a whole chunk of that's the maintenance and the wiring and software that goes with it. So I mean, the machine itself, box of plastic and metal, and worth a pinch of shit if it goes out the door.
But don't tell our credit team that.
Which is a very nice segue. Most people don't believe me, but Bernie's actually early to late 20s. Like a lot of you guys, he's had to go through the GFC, and I imagine the GFC probably had an impact on a lot of you in different ways, some positive, some negative. Bernie got all his grey hair from having to work with credit throughout the GFC. So Bernie, just to elaborate, it's fair to say 5 to 6 years ago, the credit decision process, what credit we're looking at, is a lot different as to what it is today.
Yeah, I guess it pretty much changed the rules, because prior to the GFC it was a totally different platform, and as what happens a lot when things go wrong is you get a lot of experts or so-called experts that come in and try and sort of pick everything apart. And you know, they come up with some reasons as to why the GFC was there and how it happened. You know, the first question you asked there, I guess, is where were they before? But afterwards, the two major things that they looked at was combination of irresponsible lending and also repackaging of debt to make it look, you know, better and better than it really was. When you know, everything went a bit pear-shaped, it was pretty much the credit analysts of the day that were blamed for it. You know, they weren't following due diligence, they were concentrating solely on an asset, as Pete was alluding to before, rather than the credit, rather than looking into a little bit more, you know, forensically, I guess, of the actual clients that they were dealing with. So they pretty much got hung out to dry, and it was considered, you know, their fault and whatnot. So the current credit analyst is, he's looking at every single deal that he's doing, or she, and from a purpose that it's going to be hindsighted. So almost every single transaction that today's lender does is going to be looked at by a management team. Okay, is it getting done in our, you know, the right way for us every time? And heaven forbid if that deal actually goes south, there'll be a microscope on that particular transaction to try and work out, you know, what could be done better, what didn't you get, what were you supposed to get. So unfortunately, you know, a credit analyst maybe from a while ago would look at a transaction from how do we get this through. Nowadays, to be honest, it's probably more of a what are the negatives? How can this not be a deal? Because I don't want to put my name on this if it isn't going to stack up. We're obviously, well, not obviously, we're in sales, so it's our job to have those discussions between the front line and also back to credit. However, two of the major things that they do need to look at nowadays is track record and serviceability. And they're the key areas that they need to cover off on to make sure that that's there, so that if anything did happen down the track, at least they're covered. We did the due diligence, etc. So one thing that, so track record is just how has the business been running over whatever period of time. Have they consistently paid their debt back? And the other one is serviceability. So do they actually have enough money? Does the applicant have enough money at the end of each period to cover its debts and the repayments that it has? The main way of finding that out is through a customer's financial statement. So today, it is far more important to, the financial statements analysis. So whilst it's always been there in the past, today, that is probably the most important thing, and that's why it is so important for everyone to be keeping an eye on their financials to make sure they're current and as positive as they can be.
Yep, gone on the days of saying, hey, I'm not making enough money, and for the tax man or whatever it is that we used to do in the past, because they're looking at that more so now.
Mike, you should be on our panel. So, Pete, you've got a lot of experience running a business. It had, as Mike's alluded to, it has changed over the last few years, direction from accountants, especially when looking at future needs.
Yeah, I think you hit the nail on the head. So 20 years ago in business, you would be advised by your accountant on, you just plan your business and everything so that you appropriately had the business performing at the end of the year to minimise tax. Paying all the appropriate tax you should, especially since we're being recorded right now. But as Kerry Packer said, they don't spend the money that wisely that you want to pay them more than you are legally liable to. So you made sure that you dealt with your business in a fashion that was handled appropriately. One key lesson, if you can take out of today, is the serviceability piece and making sure that your financials give you the capacity to service what you're going to need in the next 12 to 18 months in equipment funding. So, for example, if you're wanting to get away with not needing directors' guarantees, the substance and financial performance of the company becomes a key measure. But even if you do provide your directors' guarantees, that piece is essential. So it's very hard today to know what you're going to need in 12 or 18 months because we're in a world that's changing so rapidly and technology is changing so rapidly. But to keep up with the pace, you're going to need to buy some form of assets, and so you can roughly estimate what funding you might need. Make sure the profitability of the business shows that you have the ability to service that debt when it comes due, because the hindsighting that the credit people have been exposed to means that they now look at a deal as if it's going to be hindsighted. The deal's fallen over and you're looking for the holes. Or a manager pulls the file out and he's looking for things that they should have picked up before they approved the deal. So they're looking at it with that negative filter on. And what we do is we help prepare you so that when you propose your solution, you've painted the right picture so that when the credit analyst looks at it, he goes, he's never going to get fired for making the right decision, and unfortunately during circumstances you lose a major client, a major GFC hits, something like that hits. In business, unfortunately, some businesses fail. So it's not that piece. It's if they lent money to someone who it was obvious that they were likely going to fail, that's the piece they have to cover. So our job is to hopefully have you come out of today going, okay, I know what I need to plan for, so when I go to get my funding, it's going to be under the terms that I want to do, not under the terms that someone can dictate to me, and hopefully give you the tools to set your business up to be able to take advantage of those opportunities when you come out. And a piece of that is making sure the profitability is sufficient to get you the funding you need for whatever you need in the business.
Absolutely.
Do you guys have major strategic economic thinkers in the business to look forward to the next GFC? Because I mean, GFC was based on subprime loans, over-servicing of not 100% loans on properties and all that sort of baloney. And it looks like it's starting back to the same old bad habits here. I mean, they did cut it back to 80%, now you see some lenders talking 90+%. They're getting into the bad old bloody habits again. I mean,
I'll put the disclaimer around, this is my personal opinion, not the opinion of Investec Bank. but the reality of it is, we go through cycles, and greed gets the better of everybody, and hopefully the next financial crisis won't be caused by the banking industry, which this one clearly had an influence on. As your sales budgets go up, you try and create new ways to win business, new ways to write business, and as you say, if we get back to 105% lending on property, we're just waiting for another disaster to happen. So will our economists see it? Well, not if they're letting our bankers do that. If they really saw it, they wouldn't have allowed that to happen.
I'm talking about your business, Investec.
We have some of the world's best economists in there, and they do give us some very good foresight into what's coming down the path. Will we have another one? Absolutely we will.
Do you communicate that to your clients?
As best we can in a timely fashion, but we do. Michael Powers, our lead economist, is exceptional and actually quite entertaining to present. And he will be coming out here, I think, sometime next year, so we might be able to create an invite for everyone to that session. But again, economists are quite often right and quite often wrong. It's just which time they're right and which time they're wrong. That's the only thing.
Usually right after the event.
Yeah, that's right.
Is that why you put that there? Some of the back blues, some of the back things.
I will park that topic because we could go for a while and we are short of time. I want to make sure we address this. Let's throw it up there. So, Pete, obviously personal guarantees are often asked for within this industry, often required. What is the hot point around personal guarantees?
Okay, the main reason that the credit team look for a personal guarantee is they go, there's no one who knows their business better than the business owner. So if a business owner doesn't want to say, this business is sound, I stand behind it, that sets off a red flag. The things that remove that red flag are financial performance is so sound that the business does stand up on its own. If the business has a net worth in excess of $1 million, they start considering it, depending on the amount of the lend. But and I had to practice what I preached. In the 20 years I ran my own business, I gave personal guarantees on everything I did, and we were a very substantial business at the end of that. It would have been very hard for me to look at you straight in the face and say, if you back your business, you give a personal guarantee if I didn't do it myself. So that was one of the reasons. I was probably on the size that I could have refused, but I didn't have any fears about the performance of the business, so I did provide it. So the main reason they do it is they ask 10 less questions, supposedly. If the director says, well, I'll back the company, then that makes it a lot easier for them to lend the money with confidence. If they don't, they're looking for what you're worried about. That's why they go to that. So can you get deals done without directors' guarantees? Yes, and we do regularly. On the smaller transactions, we do it just because it simplifies the whole paperwork process. Once you go over $50,000, they start really seriously looking at why you're not providing it. And typically, it's large enough businesses don't need to give directors' guarantees, I think, and that's on a case-by-case basis. I don't know if that answers your question entirely, but it's sort of, that's their...
Yeah, no, I hear where you're coming from. I guess sometimes I get asked for directors' guarantees or personal guarantees, and not necessarily from an organisation such as your own bank, and they haven't even asked for my personal assets, so they don't even know if I'm worth anything. And I think, you guys are kidding yourself. Why are you asking me for a personal guarantee when I might be worth nothing?
And even if you were at the time, by the time they have to call on it, you aren't worth anything, because you've taken debt up to your eyeballs to try and save the business. There's nothing left. We have that argument with credit all the time. Well, you don't pursue them in the courts anyway, so why do you do it?
Yeah. Part of the thing there also is they can get stuff in the background that you might not know that they can get.
Yeah.
So as an example, title searches are public information if you pay for it. So, your biggest asset is more than likely going to be your property, and that'll be, we can just do a search on Peter tomorrow, Peter Spencer, and it'll come up with any property that we own. That'll be our asset, so we'll know that you have, they might be mortgaged to the hilt, but we'll know that you've...
We know if you've got a mortgage.
How do you get that, as far as, if he hasn't signed anything that says you can search by name? I mean, it's
no, he has to have signed before I can.
Privacy Act has to be signed.
Yeah.
So my team's absolutely taking no cues on our time.
We're ignoring you standing up, don't worry about that.
We did have a system in place, but they've ignored it this time. We haven't managed to cover everything, but it has been a very interactive conversation. I thank you for that. We are here. Please feel free to grab a business card. We're more than happy to discuss with you further options. There are different funding options, and there is a fundamental difference between the big four banks, the traditional banks, and an asset finance specialist, especially around the security that they take. So there is a bit more there. We are out of time. Thank you for your time.